Into university education. Today we're going to look at what's traded in Forex. This is part of our basic program. As always, just a reminder that everything we go through is intended to be educational, instructive, not to be construed as personal investment advice, as we are not financial advisors. So when you trade in the FX markets, you're literally trading two global currencies, and they're paired together to create an exchange rate, meaning if you exchanged one currency for the other, here's the rate at which they're exchanged. So when you trade in the markets, the first currency you see listed is what they call the base currency. And sometimes the US dollar could be in the front or in the back. Sometimes the euro could be in the front or in the back. The first currency listed is called the base. So in this case, the euro is the base. The second currency listed is called the quote. The US dollar is the quote. And literally, it's telling you how much US dollars, how many US dollars it would take to get 1 euro. That's what the exchange rate is. So if this were quoted at 1.20, it means it takes $1.20 USD to get 1 euro. We'll explore that a little bit further. So the exchange rate or value is the price. And when you pull up currencies on a trading platform, you'll see this price where it's trading right now. So at this quote, it tells us it takes $1.14 US to get 1 euro. This $1 would be called parity. So if it were at trading at exactly 1, that means 1 euro is exactly equal to 1 US dollar. That would be parity. Sometimes the exchange rate will be less than $1, sometimes it'll be more than $1. It could be above 2 and so forth. If you get into the British pound pairs, it might take, 2 Australian dollars to get 1 British pound. So this quotation is how many of the second of the quote currency does it take to get 1 of the euro. So if we were traveling to Europe, let's say, and we wanted to change our US dollars into euros, well, if it takes $1.14 USD to get 1 euro, we know that our 500 US dollars will not stretch as far in Europe, meaning if we exchange at that rate, 500 US dollars divided by the exchange rate of 114, we would get back 438 euros. So 500 US dollars would be equal to 438 euros. That's what that exchange rate is. When you're trading in the FX markets, you're making a bet on the price. You're saying either I think the price is going to go up, meaning the euro is going to strengthen and the US dollar is going to weaken, or I think the price is going to go down, which would mean the euro is going to weaken, the US dollar is going to strengthen. Whichever way you think the price is going to go, you're going to trade that first currency in that direction. So if I think this price is going up, I would buy Euro USD. If I think that price is going to go down, I would sell, I would short Euro USD. So in currency pairs, there's all sorts of examples. Again, US dollar CAD. If we look at that quote, $1.26 Canadian to get 1 US dollar. So it takes more Canadian dollars to get 1 US dollar. It tells us the US dollar is stronger than the Canadian dollar from the standpoint of parity. Look at the Aussie versus the pound. It would take $1.77 in Australian dollars to get 1 British pound. So, the exchange rates, again, they can differ. There's even a little bit of a difference with Japanese yen pairs because it takes a lot of Japanese yen to get 1 currency. It could take 100 Japanese yen to get 1 US dollar or 200 Japanese yen to get 1 British pound and so on. Takes a lot of yen, much more than something that's trading close to parity. Those yen pairs are way away from parity. It takes, in many cases, 100 yen just to get 1 of the US dollar, or 1 Canadian dollar, or 1 Australian dollar. It takes a lot of yen to do that. So that's a little bit of an introduction to what trades in the FX markets and how it works. Hope you've enjoyed this video. We'll see you next time.